I just bought MAA stock on Monday, and here's why. They're a residential REIT with apartments across the US. They have a current dividend yield that is at the highest point it has been in 5 years, 4.6%. They've grown the dividend at a 5-year compound annual growth rate of 8.7% and a 10-year CAGR of 7.25%. And they've been either keeping their dividend at the same amount or increasing their dividend without fail since 1994. But we can't just look at dividend metrics in isolation. We want to know how safe the dividend is. From a macro level perspective, we know housing is essential. The cost of it is tied to inflation. So it would be the last of the business sectors to fail if there were a severe economic downturn. And rents escalate with inflation. Furthermore, their current occupancy rating is at 95% across all their units, showcasing how in demand housing is. So now the first financial metric we want to look at is total revenue and determine that it's growing consistently, which it is. Here we see they've grown their revenue from $1.57 billion in 2018 to $2.13 billion in 2022, a CAGR of 5.15%. Next, we want to look at adjusted funds from operations per share, which is comparable to earnings per share for REITs. Here we see their core AFFO per share has grown consistently at a CAGR of 7.47%. And to affirm their dividend safety, we want to calculate their AFFO to dividend per share payout ratio, which, as of 2022, was 61%, which is very low for a REIT and indicates the dividend should be safe. Next, since REITs often raise capital through issuing more shares, we want to investigate the degree of share dilution, although we already know it should be reasonable given their AFFO per share growth rate, as it is a per share metric, which has only grown slightly at a rate of 1.58%, which is fantastic for a REIT. The next all-important metric we want to look at is total liabilities, which is extremely important in today's high interest rate environment, as REITs typically carry a lot of debt. Their total liabilities have only grown slightly by a rate of 2.57%. Again, this is incredible for a REIT, but it's important to compare debt in relation to income, or AFFO in this case. Their total liabilities as of 2022 to AFFO was 5.5 times, which is quite low compared to the industry average. Those were all the fundamental metrics I analyzed, and I found the investment risk to reward potential compelling, but I also realized the importance of technical analysis. So here we are using thinkorswim, and the primary tool I like to utilize is the standard deviation channel, which is a statistical metric for determining the average price indicated by the center yellow line. We can see that the price is currently far below average for a 5-year period, roughly 45% below average. Additionally, the bottom of the 5-year standard deviation channel often acts as a support level and typically elicits meaningful price action. The relative strength index graphed at the bottom of the chart also recently indicated a buy signal, displayed by the green arrow. So the combination of the fundamental and technical analysis are the reasons why I purchased this stock on Monday, and is still at a similar price level today. My thesis is that the risk is low with such a high dividend yield, intact fundamental metrics, and a favorable risk-to-reward condition from a technical perspective. But maybe you're wondering why the price is so low. Well, that's because interest rates have been rising and the real estate sector typically carries a lot of debt. And virtually every REIT is punished by the macro-level influence as they trade within the same sector. Let me know what you think of my investment thesis and if you're buying the stock. Thanks for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.